We have N. Jayakumar, MD and Group CEO of Prime Securities with us. Jay, it's great to have you on the show and on such a fantastic day. I mean, I have to start with your take on whether markets will move in line upwards if there is a Trump win.
Well, I think for starters, thanks for having me over. I think the markets have, even as of yesterday, started factoring in a Trump win, and that's only got accentuated over a period of the U.S. trading hours and this morning U.S. futures and the way the markets are expected to open. So I think a Trump win along with the House plus Senate coming through in his favor kind of indicates that you could have very decisive policies going into the new presidency. And from the way the Indian markets are positioned, we needed a correction. October gave us exactly the opportunity for one reason or the other, because reasons typically follow. And whether it is something as simple as the markets being overvalued, everyone being complacent and bullish, to the fact that a lot of tinkering around where changes in securities that are eligible for margins, etc., came in. Essentially, the headwinds were just too strong and the markets had to correct, which they've done, 7-8% from the top. And I think over the last 2-3 sessions, they've been giving indications of a bottoming out kind of formation. And my own assessment is that come the 48 hours from today, assuming there isn't a shock outcome in terms of the U.S. presidency not being decided, and think people go to court, etc. Barring that outcome, I think we're back to our own fundamentals, our own bottoms-up stock picking, as it were. Of course, the big issue really that, as I see, is that Trump will come down much harder on China, and which in some parts could benefit India, in several parts could actually benefit individual sectors like metals, etc. So I think the world will move more and more towards being insular, rather than view this as a global village, because manufacturing is going to be the big theme in the US going forward, as it in fact has been the theme in India for the last several years.
Jakes, hi, it's also Samina joining in. US election outcome aside, the last month has been about Indian markets decoupling and dealing with our own problems. So be it losing out to China in terms of valuations or flows, disappointing earnings, slowing down consumption. I mean, the list is extensive, and all of this usually comes retrospectively, right? From where we stand right now, we've had a small correction, about 7-8% from the record highs recently. Do you feel like the concerns of overvaluation are just about slightly behind us? Because while the benchmark might not have corrected, stocks have declined quite sharply and portfolios are in trouble.
Well, I wouldn't go to the extent portfolios are in trouble, but I think portfolios have fallen obviously substantially more than the indices have. And a correction in a bull market typically would be where people look at headline indices to figure out market bottoms, whether interim bottoms or otherwise, and try and see if they can bottom fish. Whereas portfolios have already, fallen between 20 and 25%. In some cases, the falls have been as much as 35 to 40%. So the way I see this is all the correction that we can expect on a more sustained basis. I personally believe that indices-wise, why the bottom will happen or has happened is that many stocks and many sort of dominant stocks in certain sectors, I think, have decisively bottomed for now. And therefore, from that perspective, you may have new leaders going into the next run, if you will. And from that perspective, I see a combination of pharma, banks, especially private sector banks, maybe small private sector banks as well, but led by a couple of large private sector banks, pharma, possibly metals could be the leaders into the next round.
Jakes, good morning, Neeraj here.
Hi, Neeraj.
So if indeed this is how the cookie is crumbling, is this a net positive from the markets in the slightly medium term, or would the thwarting of a rate cut trajectory mean that fund flows which were supposedly going to come to emerging markets from the US in an otherwise scenario might get thwarted, and that kind of puts pressure on the way we saw in the month of October?
Well, when you talk about overseas flows, I don't think we can be worse positioned than what we've been over the last several years. The FIs have only been selling. And in fact, I go back to a much larger theme which played out in the US. And a lot of themes that play out in the US actually play out in India as well over a period of time. The US markets have seen the 401k flows as being the bulwark of their markets from 1980 onwards up to today. So whether you had overseas flows into the US markets or not, the local flows always happen. And that has been, as I said, the center stage, which we can never run away from. Similarly here, the SIP flows, the retail flows, over the last 5-7 years, domestic savings were at 3% that moved into equity, have now moved to about 5.5, 5.75%. And at best, it's a tad under 6%. Going forward, I think this could easily double over the next 10, 12 years. So what we're talking about is a much larger flow coming through from the Indian markets, from retail Indian public into the Indian markets, rather than overseas flows necessarily. Of course, there will be periods of time when the FOMO impact or whatever of people who've come in at the margin into India will want to move out and capture spaces like China, etc. But the paradox again is any market that can give you a 52-week high and a 52-week low in the same week, which China did, which, to put into context, is so absurd in terms of, what should I say, liquidity or people being positioned one way, that there is no way that you can actually capture this unless you are invested in China. A lot of investors are actually got out. So they believe that the best way to capture China is to sell into strength in India, which could be a short-term play, and move into China to capture an upside. I'm not too sure if there's too much of the upside, because all the flow of news that has happened subsequently has been well short. The rhetoric has been far more powerful than the actual substance. And therefore, people, I don't believe, because we'll actually make money in China, given the structural issues of aging population, an economy that's completely manufacturing driven, and where the world at large is going more and more insulated and putting all kinds of barriers. So their export part of it is actually going to get restricted. Domestic consumption has been an issue for a long time, especially retail consumption. Balance sheets of state governments, etc., have been seriously broken. And I think any new stimulus only ends up washing out or sanitizing the earlier stimulus. So I don't, for one, believe that this Chinese politico-economic rhetoric has anything to do with reality. And yeah.
No, fair call, Jakes, in which case, okay, let's leave that out. So I would love to understand, how are you thinking about India then? I mean, is this where we start a bit of a recovery pattern, because it's been a 9-10% gash in less than 45 days? Part one question is that. And part two, themes that you bet on. I mean, 2 years ago, you were betting heavily on real estate, worked out beautifully. You were working on metals, worked out beautifully. What's up next? What's the big bet?
I think the big bet is we continue to look at manufacturing, PLI, and other kind of themes in India. Infra and the push into infra, anything related to infra will be a great place to continue to bet on. I think pharma from an external perspective, because anything that reduces the spend by either the US insurance companies or the individuals concerned, which is pharma and the Indian generic space to that extent, will be a huge positive. And pharma has been showing a relentless secular uptrend. Several companies have one or two products that sort of shine in this particular space, but there are companies with a far broader portfolio which have done extremely well. And barring a quarter here or quarter there, I personally believe pharma could be a secular theme into the next few years. Things like solar, etc., we need to be a bit careful about, because they are novelty value. There are massive duties. US will go all out to foster manufacturing within the US. So duties will be levied, whether they come from India or they come from China. China may be a lot more than India. So there's protection that's going to play out. So I personally think that a combination of, and from a domestic standpoint, we continue to think the way we did think 4 days ago, which is financials have bottomed out. Domestic financials are at historic lows in terms of multiples. And if you look at whether it's private sector banks leading the way, they're at lower price to book multiples than ever before. Some smaller private sector banks are at even lower multiples. Of course, there are one or two sectors that have been of some worry, MFI, etc., which I think are transitory and will play out. But other than that, with deposits now, the growth in deposits now leading the way compared to growth in advances, I think a lot of the banking problems could also be behind them. So I think banks are well capitalized, well governed, maybe over-regulated. And if that kind of eases off a bit, I think financials could give you a great opportunity, at least from a domestic economy facing point of view. Other than that, as I said, nothing changes from 4 days ago. We continue to look at local markets the way they ought to be looked at, not necessarily in a global context.
What do you feel about consumption? Jakes, you talked about how you think banks may be in a good place right now, but do you feel like the worst is probably behind the consumption space? The reason I ask is because while earnings were not so strong, commentary from most of them sounds pretty promising.
Well, I think the consumption has been an area of concern, linked to which has been, the proliferation of cards and whether people have been, having consumption through borrowed means, if you will. I think we are still under-leveraged as an economy, so that's not such a worry. There will be periods when the noise around this will reach a crescendo, which has been the case. Maybe 1 quarter more, and consumption should slowly inch back. I'm not a great believer in the fact that that Indian consumption is going to be sort of challenged. At the same time, I don't believe it's going to be the way forward. So consumption-oriented stories are not going to be necessarily leading the next rally. Though I do believe that consumption will pick up maybe a quarter or 2 quarters down the road.
Okay. Jakes, what is the concern now? I mean, is it the earnings growth, or do you believe even that is passing if indeed the government spend comes back in the second half, which a lot of people say it will?
Well, it's been back-ended. Usually it's been front-loaded. In this particular year, it's been back-ended. And the second half, whether we like it or not, will be significantly higher than the first half. So if there's one engine that needs to fire right now, it is the government spending, which has been significant in the way it's been lacking in the first half. So there's no doubt from that perspective. I do believe that some amount of private sector capex needs to get constructed and created, which has also been lacking. But I've not seen the same zeal to create capex in the private sector space, as has been envisaged.
Mr. Jayakumar, just wondering what, as per you, would be the next big triggers for the Indian markets? I mean, right now, I know we're in the middle of a US election and all our focus is on that. But towards the end of this month, we come to a very, very key state election, which is of Maharashtra. Do domestic politics then come to the fore? Would that be a bit of a, huge factor and possible headwind that markets would watch?
My own assessment is politics will come and go. They don't last beyond a couple of days, unless the outcome is so dramatically different from what was envisaged. Maharashtra is seen as a challenging state. If the ruling sort of dispensation does better than expected, we'll take it in our stride and move on. Unless the performance is disastrous, which I don't think will be the case. Therefore, if you take politics apart, keep it aside. I think there is no really next big trigger, as it were. I think the real trigger, if you will be in terms of, let's say, some easing off in certain pockets of the economy which have seen strife and stress. Maybe in the last elections, there was general talk that there'd be, loan waivers, etc. So the MFI space was delinquent to a larger extent than was envisaged. I think that could ease off. Private sector capex could be a surprise plus. Government sector, infrastructure spend needs to happen, and it's largely been factored in. How much that will actually impact, because we've never had a year where the government spending has been so back-ended as it has been in this particular year. So keeping that in mind, I think we will meet with some tailwinds, or we will experience tailwinds into the next half. And to that extent, the markets, to my mind, have already bottomed out 3 to 6 months ahead of the actual tailwinds emerging. So you go back to stock picking, go back to boring reading of balance sheets if that in fact is a trade that anybody still follows. But to the extent that some people still do, I think we go back to that. Low-hanging fruits probably aren't there. Thematic upsurges could happen. A worry could end up being a situation where it was raising money at a 15,000 crore market cap a year and a half ago and lists and trades at a 1 lakh crore market cap. Those kind of things could happen. But that's also a function of novelty as much as it's a function of a new trend that the market's latched onto. But I don't see anything so substantially big that that the next big trigger is waiting to happen. No, I don't think so.
Got it. Okay. Jakes, lovely talking to you as always, more so on such an important day. Thanks for taking the time out and being with us.
Thank you so much. Thanks for having me.